Hey everybody, hope everyone's doing well. This is the Emini review for Tuesday, June 18th, 2024, and starting with the daily chart today. We had that big bull trend day yesterday, so bull trend bar on the daily chart here. And the expectation after a trend day is, well, in general, you get a trend bar, climax bar, you expect 1 to 3 bars sideways. And so that would mean you expect today to be sideways at least. And when you think about what the market is doing when it's trending, Al talks about this in the books and in the trading course. Markets are always looking to facilitate trading. They're looking for a fair price so that the maximum number of bulls and bears initiate trades. And so if the market's trending, the price is wrong, and we have to keep going higher, in this case, to find a fair price where we eventually find a trading range. Trading ranges represent a fair price. So the expectation coming into the day is the first 2 hours at least to be sideways, or let me rephrase that, within the first 2 hours, sideways to down, and some sort of correction. But with such a strong bar, there's probably buyers somewhere below within the range at support. And it depends on where we opened, but we're obviously closer to the high of the bar than the low. So it's more likely we would test the high of yesterday and see what was there rather than the low. And the 5-minute chart. So when we came into the day, we had this strong rally. We went sideways, so maybe a tight trading range, final flag, and then a bear breakout attempt. But the market's more likely in a trading range, like I said. More likely we start to go more sideways here. And the lower probability event is that the market goes from such a strong bull environment into a strong bear environment. So today the expectation is either a trading range day or a bull trend day. Bar 1, you can see what we're doing. It's a continuation of the pattern from yesterday. So trading range here, bear breakout attempt, but bad context. 80% of breakouts of trading ranges fail, and you're against a bull trend. So the bear breakout is failing. We get a bull trend bar crossing the moving average, closing on its high on bar 1. It's a strong bar for the bulls. However, the context is bad for the bulls. Think about the fact that the market's in a trading range. You had a micro channel from bar 68 to 72 yesterday, so bulls were buying here, hoping for a second leg up, knowing they could probably scale in lower and make money. Well, if a bull bought there and this is what they got, they're obviously disappointed. So bar 1 could be racing up to test that magnet. When the market's in a trading range, gaps tend to close, and right now we have a gap. You can argue it got tested on 75, but the gap is still open. So bar 1 might be a vacuum test of resistance within the middle of a tight trading range, so not ideal to buy. Bar 2, you can see we rallied a little higher. You can see where we tested. It came within a tick of the bar 72 low, so obviously that price was important. Bar 2 is minimum follow through for the bulls, so bull breakout bar and then a doji with a bull body, minimum follow through, but it's really a bear bar. There's more selling pressure. There's a bigger tail on top. So that's bad for the bulls. We're high in a trading range, and now we've had a buy climax with bad follow through. Strong enough up, it'll probably get a second leg. But I just said, if the market's in a trading range, gaps tend to close. We also have a gap from, you could argue, the bar 80 high to the current price. So down here, it's probably a magnet as well. And the odds that bar 1 remains the low of the day is about 20%. Probably sellers above bar 2, scaling in higher. And buyers below 2, betting the first reversal down will fail. It's a bad sell signal bar for stop orders, and strong enough momentum up for a second leg. Outside bar on bar 3, so an expanding triangle on a lower time frame chart. The market's trying to break out above the bar, failed, below the bar, failed. So it's a trading range within a trading range. And overall, in this bigger trading range, we're high in the range. So if anything here, you could argue bar 3 was the second leg up for the bulls. up here for leg 1, pull back below bar 2, and then bar 3 rallied. And you can see we tested the bar 72 low and exceeded it. So any bulls who bought there, scaled in lower, they were relieved. A couple of doji bars, so the market's going sideways. And like I said, overall trading range with yesterday's price action, so probably more sellers above bar 3. There might be buyers below, but because we might be high in the range, we can easily test down to the bar 80 high as well. Bar 4 is a bear trend bar, but it's following an outside bar, and in general, outside bars are trading range bars, and context does play a role, but in this case, the context is a tight trading range, and so there's probably more buyers below bar 3. This is still the first reversal attempt, strong enough leg up for a second leg. Some traders argue bar 3 was the second leg, others argue all the way up to bar 3 was leg 1. This is part of the pullback. And bar 4, it's a good looking bear bar, but it's relatively small and completely above the moving average. And so if we are in a trading range, what happens? The institutions see something bearish and they buy. And of course the opposite, they see something bullish and they sell. So probably buyers below bar 4 scaling in lower. And then an outside bar 5. The problem, again with outside bars, they're trading range bars. The market tried to break out below bar 4, it failed. Tried to break out above bar 4 and failed, closed within the range of bar 4. Look at the past 4 bars. A couple dojis, a couple trend bars, but the trend bars completely overlap one another. And just look to the left, the market's in a tight trading range. So with bar 5, probably more sellers above. It's a high one, but not in a strong spike phase. High one, high in a trading range. The high of the range could be all the way up here at yesterday's high. So if you are selling above, probably scale in higher. And then another outside bar on bar 6. So OO pattern, breakout mode, expanding triangle on a lower time frame. What about selling below bar 6? It's a second reversal, magnet below. You can, but again with bar 6, just look at the past 5 bars. Every time let's just say you were selling below bars. You sell below 2, you got trapped. Sell below 3, you got trapped. And then what if you're buying above bars? Same thing. It's a limit order market. So what about selling below 6? I would not. If anything, probably buyers below 6, sellers above 6. Still an outside bar, so an expanding triangle. Not ideal to sell low in an expanding triangle, which would be the low of bar 6, within a tight trading range. And then again, we fell below 6 and reversed up on 7. So very tight trading range over the past 5 or 6 bars. You can see the market is between 2 magnets that I have drawn, which are the high of yesterday and the high of bar 80. Why is the high of bar 80 significant? We had a strong enough breakout here for the bears to expect a second leg. Now this rally was disappointing, so any sell-off will probably lead to buyers below. But because the market's in a trading range, I do suspect we'll come down and test the high of bar 80. I also think we're going to test the high of yesterday. So I suspect we'll do both. I don't know which one we'll do first. But that's what the market's deciding in this tight trading range. We're up and down, up and down, up and down. So what about buying bar 7? It's a high too, but the problem is, I used this example yesterday. Bar 30 was a high 2 and a strong bull trend above the moving average, and that's a good setup. But the context is different here. This is a high 2 in a tight trading range and relatively high in the range. So for a high 2 in this context, there are probably more sellers above, scaling in higher. You run the risk if you sell above 7 that it's leg 1, maybe 2-legged pullback, leg 2. But I do think if you sell above 7 and scale in higher, you'll be able to avoid a loss. Inside bar on bar 8, so reduces the probability for breakouts. It's an inside bar within a really tight trading range. The market's in breakout mode, and tight trading ranges are one form of breakout mode, and you can also argue the market's in the triangle. Different computers see it different ways, but many of them will see that the market's in breakout mode, and we will get a breakout attempt eventually, and then we'll have to assess whether the breakout looks strong enough for a second leg, or even more, or whether the breakout will fail. A doji on bar 9, we tried to break out above the inside bar 8, and failed. And that's common with inside bars, especially in trading ranges, sellers above and buyers below. Now we have a doji bar 9, probably sellers above, buyers below. But again, breakout mode. And then bar 10, we have a breakout bar for the bears, closing below the moving average, but still within the tight trading range. And every time there's been a bear bar, the bulls bought it. So that's the problem with bar 10. So some bulls will buy bar 10, betting the bears need at least one more bar for this to be a breakout. Technically, it is breaking out of this trend line, and I'm using it as the triangle, the bull trend line in the triangle. So technically it's breaking out, but it's not breaking out far, and the context is bad. It's a tight trading range. The apex of triangles are magnets, and that's because of what I said in the beginning of the video. Markets are always probing up and down, looking for prices to test and looking for a fair price, which will facilitate the most trading. And you can see what's happening here. The range is really tight, and for how many bars? About 9 bars, we've gone sideways with a lot of overlap. This is clearly a fair price. So any breakout attempt will likely, even if it gets continuation and goes for a measured move, will likely come back and test this area because it's been agreed upon that this is a fair price. So bear breakout 10, followed through 11. Good looking bars for the bears, but the context is bad. You know there's probably support below bar 1, strong bull trend bar, buyers below. Maybe even buyers at the open of the bar. And you can see where bar 11 is approaching. Other traders, they'll see it as a wedge, 3 pushes down on bar 4, 6, and 11. Something like that. So it is breakout mode, but remember 50% of breakouts of triangles are in the wrong direction, and they reverse. So bear breakout attempt, but let's see if the bears can get more follow through with this wedge and the support to the left. Look at bar 12, you can see bar 12 tested the open of bar 1 and reversed up. That's a disappointing bar for the bears. Possible wedge 1, 2, 3, but micro channel for the bears, 4 consecutive bars with highs below the high of the prior bar. Bar 12 a weak buy signal bar. This was strong enough for a second leg. You can argue it's a third leg down, so 1, 2, 3 again. And so the probability of a second leg is either reduced or the probability of a deep pullback is increased. So that's the problem with selling down here. Probably sellers above 12 scaling in higher. But also remember what I said, the apex of the triangle is a magnet. So we're getting a bear breakout, and now it looks like a reversal attempt. And then 13, a bull trend bar, possible vacuum test of resistance, testing basically the middle of the tight trading range. The bulls are hoping it was a wedge bottom, and then we go for the first test, which would be maybe the bar 6 high, maybe the bar 3 high, and then for a measured move up based on the height of the wedge. But there's a lot of resistance to the left, including above bar 6, bar 3, the high of yesterday. And with all this overlap, trending behavior is unlikely. It's a very tight trading range, so vacuum tests like bar 13 typically get sold. Whenever there's a trend bar in a trading range, traders see it as an opportunity to trade in the opposite direction. So consecutive bear bars, but getting low in the range, they buy. Consecutive bull bars, getting high in the range, and they sell. 14, a disappointing bar for the bulls. It's a high 1, but a bear bar, high in the range. Sellers above bar 14. And like I said, this, even though it was a leg 3, it was strong enough for a second leg down. I said the probability of a deep pullback is increased because it's leg 3 and because it's in a trading range. So here's our deep pullback. Maybe we go for a second leg down here. And then 15, bear breakout, still within all the bars to the left. So not a very strong breakout. It's really only breaking out below these two bars. But consecutive bars, completely reversing 12 and 13, so it's good for the bears. But there's still a lot of support to the left to worry about. Does this look like a strong bear trend? Of course not. It's the trading range. So buy vacuum up to 13, sell vacuum down to 15. The bulls hoping 15 leads to a double bottom with bar 12, and they're looking to see what the next bar looks like, hoping it disappoints the bears and sets up a decent signal bar. And instead we got a doji. We're testing the low, where we broke out one tick below the low of bar 12. And then we pulled back immediately. It's a 4-bar micro channel for the bears, but not great. The first bar of the micro channel is a big bull trend bar. The last bar is a doji, and it's completely overlapping all the bars to the left. Some traders will buy below bar 16 and bet that this is a trading range. They can scale in lower and be able to make money. Others see this as strong enough for another leg down. They'll sell above bar 16 and look for that second leg, but they're scalping. This is a tight trading range. Nobody's swing trading here. It's also a limit order market. Where's a good stop order entry so far today? You can take stop order trades, maybe aggressively buy bar 1, but if you do, you're disappointed with bar 2 and you probably exit at break even. There are some trades you can take with stop orders, but in general, tight trading range. Usually not ideal. 17, we're falling even further, so the micro channel for the bears is continuing, and 17 is a weak buy setup, and so there's probably sellers above, and okay to hold short. But it's hard to hold short when you have a possible wedge bottom, and you're possibly low in a trading range. Some traders see this as, let me say, big down, big up. It's big confusion and obviously a trading range. So some traders see this breakout as strong enough for a second leg up. Was bar 12 and 13 the second leg? I don't know. Might be part of the trading range, part of the pullback. So some traders see it as leg 1, maybe a wedge bull flag, look to buy here and go for the second leg up. But we could fall to, I have this line drawn for a reason. Gaps in trading ranges get tested and closed. So the high of bar 80 yesterday is probably going to get tested. 18 falling a little lower, but still on the channel line. Low probability that we get a bear breakout and accelerate into a strong bear trend. So traders are buying below bars. They're buying at the channel line, buying below bar 17, buying below bar 18. It's a micro channel, but not very strong. We got a doji. We have tails below bars, lots of overlap. The context is bad. It might be 3 legs down. 1, 2, 3. And it's also a nested 3 legs down. Look at the third leg here. And we have 1, 2, maybe 3 or 4 legs, or 3 or 4 pushes down here as well. So it's a nested wedge bottom pattern. We could go a little lower. And if you are taking any trades, any longs in here, stop below bar 79. It's kind of a weak place for a stop because the odds are if we go down there, there's buyers below. Outside bar 19. So we triggered the buy above 18, but obviously a weak buy setup. 6 consecutive bars with lower highs than the prior bar and then a bear signal bar. So we triggered it and reversed down. But what have I been saying so far today about outside bars like bar 3 and bar 6? 19 is no exception. It's an outside bar within an overall trading range. Now we're low in the range. We've had 3 legs down. And 19 is an expanding triangle on a lower time frame. So as far as selling below 19, that's the exact opposite of what traders are doing. Now it's 2 legs down, technically, here. Some will argue leg 1, pause, leg 2, pull back, leg 3. Others maybe just leg 1, pull back, leg 2. Doesn't matter how you look at it. The point is it's probably a late leg and it's low in a trading range. So as far as selling here, I would not. And if you are short, it's probably always in long because of context. even though it's looking sort of the most bearish it has all day, and it's 6 consecutive bars with bear closes, maybe a doji there. It might look fairly bearish, but it's a trading range, so always in is the opposite. So probably buyers below 19. And then 20, we fell below 19, we tested the high of bar 81, and we bounced. Is bar 20 the low of the day? I don't know. It's not a very credible buy setup. It's still a fairly tight channel down and a weak buy signal bar. But trading ranges are notorious for that. You'll have tight channels that reverse. You'll have bad signal bars that lead to big swings. An example's right here, bar 72, weak sell signal bar, big sell-off, weak inside bar, bar 80, big rally. So it's not impossible that we rally above bar 20. But I think more traders are looking to buy below bar 20 than buy above. But as far as selling above, I would not. The context does not really support selling in the bottom of a trading range. 21 fell below 20, and there were buyers below. Now we have a micro double bottom with bar 20 and 21, and a double bottom with this swing low over here. There's also a wedge, as I've drawn already, and this is a variation of Al's favorite setup. It's a double bottom where the second leg, so here's leg 1, leg 2, the second leg is a wedge. So for a couple of reasons, you're expecting support here. Why are we expecting support here? Big sell-off, you had bears selling, especially probably momentum. Bears starting to sell down here, maybe not realizing or not really not caring. When you have high frequency trading firms, they're selling momentum, scalping for ticks. They'll sell all the way down even though it was a bull trend. Eventually they get trapped. And so they get trapped on this rally, and this rally is really disappointing. And then on the way down, what's happening? Bear bar, bull bar, bear bar, bull bar. Consecutive bear bars, consecutive bull bars, and then bear breakout attempt, pause, lots of overlap in here, and it's 3 legs down. Nested wedge, double bottom. So what are we testing here? We're testing a price where bears who sold down here got trapped with this rally. They're disappointed. They'll use this sell-off if they scaled in, whether they scaled it or not. Just think about what you would do if you shorted here and the market came back after you got this. You're going to be happy to buy back your short. So that's contributing to the buying. You also have, like I said, maybe 3 legs down, nested wedge patterns. What's a wedge? Wedge is consecutive sell climaxes. So you've exhausted bears. Bears selling, scalping out, all the way down. And eventually you get 3 or 4 legs and the market reverses, especially at support like here. So there might be a stop order buy above bar 21, even though it's not the strongest signal bar in the world. The context supports it. 22 a bull bar, triggering the buy, but pulling back. Now 22 is a low 1 signal bar. But because of everything I just said, do you really want to sell a low 1 at support after consecutive sell climaxes? Of course not. Better to buy below bar 22. Low 1s are good in the early stages of a bear breakout, and this is not that. This is the late stages of the market cycle. This is 3 or 4 legs down, low in a trading range. The signal bar also has a bull body. So for a couple of reasons, it's a weak low 1, and a bad stop order trade is a good limit order trade, so buyers below 22. And as usual, you see this in trading ranges all the time. You have a good limit order trade below bar 22, and it doesn't trigger because everyone's looking to buy there. No one's looking to sell there because it's a terrible trade. So if no one's looking to sell, the market's not going to go there. You need an institution willing to buy and sell on every tick of every bar of every chart. And so there were institutions and traders looking to buy below 22, but at some point during 23, they realized they weren't getting filled. They're going to have to buy the market, maybe by the close of bar 22 or a small pullback of the body. At some point, they felt that sense of urgency. My limit order's not getting filled. Or at the bottom of a range, nested wedge bottom, double bottom, I want to get long. Now we have a bull trend bar 23, consecutive bull bars. Again, you can call it low one. There's probably more buyers below the bar if we go there, and maybe buyers above. Bears, maybe they were hoping for the breakout. We tried a couple of times below the high of bar 80, not getting there, and we didn't quite get to this swing point low. 24 is a bear bar, disappointing for the bulls, but it's the same problem for the bears. It's the low one sell signal bar, but it's a bull bar. It's a buy reversal bar closed above its midpoint. Even though it has a bear body, there's probably more buyers below the bar. It's a bad signal bar for the bulls, so as far as buying above, kind of hard to do. But the context still supports it. You're low in the range. You've had 3 legs down. And I haven't talked about magnets. Let me see. Or gaps, I should say. This was a gap below bar 14. Bear breakout 15, but in a trading range. The odds are we're going to come back and test this price, close that gap. So that's a reason. That's reason alone to buy down here. Betting the market's low in a trading range with an open gap above. You also have bulls who are trapped on bar 13 buying the close. This price might be a magnet as well. If we get there, probably find resistance and fall to the downside, at least briefly. And remember I said earlier, somewhere in here, market's constantly reversing up and down, searching for direction. I thought we would test the high of bar 80. I thought we would test the high of the prior day. Now we've done this, and I was expecting more buyers here than sellers, and it's looking like that's what we're getting. Does it look like the bears are happy to sell here? Remember what happened. They got trapped. They got consecutive sell climaxes. We spent 2 bars briefly at this price before we rallied. The bears are probably unwilling to sell again for maybe 10 bars and 2 legs. And that's the expectation after a wedge. So we have a wedge, expect 10 bars and 2 legs, sideways to up. So we tested this magnet, and now we might come back and test the high of yesterday. By bar 18, there's an 80% chance we've seen the high or the low of the day. At this point, we're near the low of the day, so maybe you could argue there's a higher chance we've seen the high of the day. But because of the context, this looks like an overall trading range. We're low in the range. Do I think we're going to get the bear breakout, especially after the strong bull trend yesterday? Probably not. If anything, we might have seen the low of the day at this point. Inside bar 25 reduces the probability for breakouts, but I would not sell above because of the context. Low in a trading range and reasons to go higher. Probably more buyers below 25. Bull breakout 26. So again, we have a micro channel. You have bulls looking to buy a pullback, looking to buy below a bar and not getting the chance. And eventually they're going to sense the urgency and look to just buy the market. And that might be what's happening on bar 26. Some bears might argue it's 3 legs up, 20, 23, 26. Well, the context is still bad. It's only been about 6 bars. It's not enough to correct this wedge. Probably going to go higher, and it's going to last more bars. The bears also don't have much of an incentive to sell here yet. Where's the good sell setup? They haven't triggered a stop order sell below a bar since 21. And is 26 a good-looking sell signal bar? Of course not. And the context is bad. Low in a trading range. Probably buyers below, going higher. 27 breakout. So bull breakout 26, follow through 27, completely above the moving average, and a pair of good bars, probably always in long. And what about what am I looking for? Midpoint of the day? Maybe the midpoint of the trading range. I actually prefer to use thirds, which is what I have here. So if this is the range, here's the high of the trading range, here's the low. The market's now just about in the middle of the trading range. The middle of the trading range, you might have heard it referred to as no man's land. It's a bad place to initiate trades. What's usually happening in the middle, you get these tight trading ranges like in here. What you have is traders selling the upper third and scalping out in the middle third, buying the lower third, scalping out in the middle third. So you might have some resistance just for the fact that we're in the middle of the range, but strong enough momentum, probably going at least a little higher. You can see we're testing bar 14 low to the tick on bar 27. But with bar 27, do you really want to sell above? Probably not. Probably going to go at least a little bit higher. $28, another bull bar. Is it by the close? It might be. It's a strong breakout, but the context can be tough because we're getting high in the range. It is a micro channel, and the odds are the first pullback will lead to a minor reversal, buyers below, and a second leg up. But at some point, the risk reward gets bad for the bulls. The trader's equation gets bad. And you have bulls, if they're buying close of 28, maybe stop below here. Their target's all the way up here, and the market's been in a trading range, so not wise to be buying the close and going for a measured move. 29, outside bear bar. So again, another outside bar, but the context, it's a rally in a trading range, probably buyers below bar 29. It's the first pullback after the strong rally. So a couple of reasons to expect buyers below and a second leg up. 30, outside bar, so OO pattern, there were buyers below 29, and we reversed up. So again, I've been saying outside bars, sell above, buy below. I've been saying that maybe 4 times today. 30, a little bit of a problem. You have the momentum from the breakout, just one pullback, and a bull bar closing on its high. The context isn't ideal to be selling here, but there is some resistance here. We could start to go more sideways, and we could be high in the range. And then we got follow through 31. So if you did sell above 30, what do you do on 31? Some traders will argue 31 is a smaller bar than 30. If it's such a strong bull breakout, why are the bodies getting smaller? And that's a fair argument. We're getting high in this trading range. There's probably sellers in this area. But look at the momentum on the way up versus on the way down. It was choppy with a lot of pullbacks and overlap on the way down, and on the way up, a lot less overlap, only one pullback, lots of bull bars closing near their highs. So probably going at least a little higher. No decent stop order sell setup yet. 32, a bull bar. It's a weak sell signal bar, probably buyers below 32. But you can see the body's getting smaller from 30 to 31 to 32. And then a tail above, sellers into the close. Might be 2 legs up, 1, pullback 2, high in the range. So you might find some resistance, but it's probably minor, at least so far. 33, a bigger bear bar than bulls would like to see, but we were high in the range. Bear breakout, a little bit of a surprise, but still more likely a minor reversal. Unlikely that this reverses straight back down into a bear leg in a trading range. It's not impossible because this was fairly tight and then we reversed up, but this was clearly stronger than this one. And again, I still have the bias. I think we're going to trigger above the high of yesterday. 33 is a good-looking bear bar, but if a bear sold above 29, they got trapped on these 3 bars, they would use 33 as an attempt to exit at break even. So we might have more buyers below. Instead, we had bears selling below 34, consecutive bear bars, but straight into the moving average. This is all one leg for the bulls on a higher time frame. So some bulls might be looking to buy a 50% pullback, maybe somewhere in here. Consecutive bear bars, but bad context. Might be a double bottom with bar 30, plus the moving average support. Inside bar 35, but bad high 1 after 2 big bear bars and a small inside signal bar. Probably more sellers above. And when we do go above, we now have resistance at bar 32, the low. You had bulls buying below, betting tight bull channel, consecutive bull bars, and then a surprise bear breakout. So if we do get back here, the odds are there are sellers there, at least from disappointed bulls. Outside down 36. I should have mentioned this was strong enough for a second leg, and that's because of the trapped bulls here, and then 36 could be that second leg. So what have I been saying again all day? Outside bars, bad context to sell low. So now we have a decent looking rally, 1 pullback, 2 legs down, outside bar, expanding triangle at support. What's the support? The 50% pullback. Let me see if I can get it real quick. And look where we're testing. Here's the 50% level. We're testing just about 50% where bulls will buy. Why do bulls buy 50%? Because no one wants to buy, I said it here, but no one wants to buy up here when you're high in a trading range. It's a strong enough breakout for a second leg. Still true. But it's similar to what happened here. Look at the bear breakout to bar 11. Strong enough breakout, it's probably going to get a second leg. But that doesn't mean you sell the close of 11 because you're low in the range. So what do traders do? They sell above the breakout. We go above the breakout here, everybody sells, then we get the second leg down. This one, so the reason, let me organize my thoughts for a second. The reason traders didn't sell the 50% pullback of the bear leg might be a couple of reasons, and I mentioned them earlier. This was a weaker leg, it was a third leg, nested wedge, and bears probably looking for 10 bars and 2 legs before they look to sell again. What did we get here? Maybe 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, maybe 13 bars up, depending on where you start counting. If you start from here, maybe it's 11 bars up, and you got your 2 legs. So bears come back in, top of the range, we're going down. But this was still tighter and stronger than this. So again, bulls, strong enough breakout for a second leg. This hasn't had a second leg yet, but no one wants to buy up here high in the range. So what they'll do is set limit orders, 50%, scaling lower, and then look for that second leg up. 37, bull reversal bar, high 2, but fairly tight channel. But for the bears, do you really want to sell above a bull bar closing on its high after 2 legs down, after a decent rally? You're in no man's land again, in the middle of a tight trading range, basically the middle of the range. So that's the problem with the stop order buy above 37, forcing you to buy in the middle of the range on a flat moving average after a fairly tight channel down by the bears. So we went sideways on 38. 38's a bad low 1. I mentioned them earlier, like down here, bad low 1. The context is bad. 50%, we're finding support. It's a weak signal bar, and it's a trading range. In the middle of the range, probably buyers below. 39, we broke out above 38, but immediately pulled back. 39, similar to 38, it's a low 1, but bad signal bar. Probably more buyers below, and the bulls looking for the second leg up. 40, a bear bar closing on its low. We triggered the sell below 39, which was a bad signal bar and a bad location for a low 1. So the expectation is buyers below. Even though 40 is a bear bar closing on its low, it's relatively small. It closed at the low of bar 39. It's not too much of a threat. And you have bears who sold at close 36, disappointed 37. They exited on 38. And we're just going sideways here. Bears not too inclined to sell. The momentum is weakening. We're going sideways. And we might end up getting a bear give up and then a rally for a second leg. So 41 could be the start of the give up. It's a bull trend bar closing on its high, not breaking out of much of anything at all, really just breaking out of the moving average and the prior bar. But strong enough if you're a bear, probably exit above it. Bulls might buy above, looking for that second leg. It is a tight trading range from bar 35 to bar 41. So if you're selling here, or if you're buying here, you're buying high in that range. But this range is minor, and the major range is all the way up here. So some traders will buy, looking for a test, maybe of the 32 low, or the overall trading range high. And then 42, we're going higher. We tested the low, so the bulls did the minimum that they wanted, testing it, not necessarily closing it yet, but now consecutive bull bars, strong enough breakout for a second leg. And this could be the start of the second leg. For the bulls, 1, pull back 2. 42, what about selling below? Probably not. Probably more buyers below, consecutive bull bars, and probably getting a second leg. So 43 triggered below 42, but failed to break out below the moving average, and there were buyers below. Some traders caught a low 2, low 1 below 39, low 2 below 42, but it's obviously a weak setup, bad signal bar, bad context. So we did fall below, and why did we fall below? Because now, at this point, you had bulls disappointed here. You're expecting, I mentioned that one earlier too, you're expecting a retest of the low of bar 32, and when we do retest it, what do you expect? Well, if you're a bull and you bought here, and this is your entry bar, and the next bar, you're saying, darn, I really shouldn't have bought there. But it's a trading range. I can scale in lower, maybe above a bull bar, and exit at my original price. So when we get there, look at the tail on 42. That's what they're doing. And that carries into the next bar. No one wants to buy here. So we fall lower to find buyers, but no one wants to sell below 42. And then the bulls overwhelm the bears, and we find buyers below. The market's in a trading range, but the momentum so far here for the bulls is stronger than the bears, probably going higher. 44 is a bull reversal bar testing this price again, but this time we've already had bulls who got trapped earlier relieved, and at this point there may be more buyers above 42 expecting higher prices. The problem with 44, it's a high 1 signal bar, high in a trading range, so you will have bears selling above it, but it's not an ideal signal bar for limit order bears because it's a bull reversal bar closing on its high. Inside bar, 45, so that reduces the probability for breakouts, probably sellers above and buyers below. And then a reversal bar, 46, so if you're a bear and you sold above, not the ideal entry bar, but for the bulls, also not breaking out above these bars, still within this range, so it could be 1, 2, 3 legs up in a trading range. So wedge for the second leg, 1 pull back 2, maybe a double top. Bears looking for a sell setup. And then you get 47. And what are you thinking? Is that the good sell signal bar you were looking for? Of course not. Now, you do have bulls selling above the swing point here. So if they bought anywhere, the market's either in a trading range or a bull channel. So traders buy below bars and sell above bars. You get above the swing point, there's sellers above. But then you're left with consecutive bull bars, a big signal bar. So if you're selling below a bull bar, which was a trading range bar, where there were probably buyers below. And it's a big bar, so big bar, big risk, low probability. Probably more buyers below. And we may not even go below before we go higher. 48 inside bar, so similar to 45, reduces the probability for breakouts. Probably buyers below and sellers above. Bears still looking for a double top, but they need a signal bar. And we've had no bear bars. Even 41 or 43 wasn't a bear bar, closed above its midpoint. We haven't had a bear bar since bar 40. So not enough selling pressure. 49, it's a buy reversal bar with a bear body, so it's a weak stop order buy signal bar. It's a high 1, high in a trading range, probably more sellers above the bar. But like I just said, the selling pressure has not been impressive. The bears do have this going for them. Might be 3 pushes up, might have exhausted bulls high in the range, but the bears still need to do more. Bull breakout 50, closing within the range, trying to get a breakout of the channel, which is low probability. And even if they do get the breakout, you have yesterday's high to worry about. So now we have 2 legs up for the bulls, 1 pull back 2. Whenever you get 2 legs up in a trading range, you start to think about looking for reversals and trades in the opposite direction. So in this case, start looking to sell. There still hasn't been great selling pressure. No bear bar since 40, like I said, so not ideal, but the context isn't bad. It's 2 legs up, the second leg is a wedge, we're high in the range. So as far as selling below 50, not ideal. If you do sell below 50, you need your entry bar to make up for your weak signal bar. Probably buyers below 50 for a scalp. 51, inside bull bar, but small and bad context. High in the range, probably sellers above. And then a vacuum test, or I call it a vacuum test. The terminology you use depends on context, it depends on experience, and it depends on how you read the chart. For me, you can see I just went to straight calling it a vacuum test. I could have called it a breakout, I could have called it a spike, I could have called it a gap. But I call it a climax and a vacuum test because of the context. It's 2 legs up, high in a trading range. Here's leg 1, pull back, leg 2. It's also 3 or 4 pushes up, maybe 1, 2, 3, 4, maybe even 5. The point is it's a late leg within a late leg. So maybe 4 or 5 pushes up within a second leg within an overall trading range. So this is the exact place beginners get trapped all the time. They see a big bull bar, 50 or 52, and nothing looked good enough to buy in here. And so they're not buying, but all of a sudden the market's all the way up here. And they're thinking, gosh, this might be a bull trend. We're accelerating. I got to get long. The problem is that the institutions do the exact opposite. There are quite a few reasons to expect resistance here, despite the strong looking bull trend bar. Starting with, and I'm sorry if I keep repeating myself, but this is the way I think through it, and this is the way I learn, and these are all the reasons why I think this is a bad place to buy. 2 legs up, 1, pull back 2, in an overall trading range, so you're high in the range. You're trying to break out of yesterday's high, but you're closing at the high. So you broke out by maybe a tick. What's the high? 61 even, 61 and a half. So we broke out by 2 ticks, but closed at the high price. Not a very strong breakout. The bulls need more. When the bulls need more, bears will sell for that very reason, betting they won't get more. So if you need one more bar, you can expect you won't get it. And this is an example of that. Bull breakout bar, but they need one more bar, so they probably won't get it. Why will they probably not get it? Same logic as why traders weren't willing to buy around here, 31, 32. If you're buying the breakout, your stop has to be far. Maybe your stop's all the way down here. You buy the close, your target's all the way up here. What are the odds we go all the way up here before back down here? Not 60%. So if it's not 60%, you can't take the trade. It's a 1-to-1 risk reward. You need at least 60%. So that's not a positive trader's equation. You have bulls who bought down here, who bought really all the way up, and they get this bar at the top of the trading range. What are traders doing in trading ranges? They're buying low and they're selling high. So you have bulls buying low, buying maybe here, and then we get to a new high and they're looking to sell. The fact that 52 is a trend bar accelerating is even more reason to sell. It's a channel, it's a bull channel, so lower probability of a successful bull breakout. Higher probability any bull breakout fails within 5 bars, and we get a test of the channel line of the trend line at a minimum, which is, I'll draw the trend line too. This is the bull trend line. So more likely we find sellers above, this reverses, and we sell off. Why would bears sell the close of 52? Because it's a big bull bar in a good spot. The context is good. High in a trading range, 2 legs up, breakout of a channel line, and now you're getting a chance to sell when the market's high, accelerating, but you have bulls on the wrong side of the market. So look at the market reaction on 53. We went a little higher, but if you sold the close of 52, you had a good entry bar 53. If a bull bought 52, they're disappointed with their entry bar, and they may just exit right below the bar. And that's the correct thing to do if you did buy. If you bought, you get out below 53. It doesn't matter where you bought. You're high in the range. You're getting a strong reversal bar after 2 big legs up, and this was a wedge. and then we fell further on 54. So credible stop order trade there. And then 54 consecutive bear bars, high in the range, probably going a little lower. One more thing about the context of the day overall. Trading range days, I'm always thinking about expanding triangles for trading range days. We went up. So here's the current low, the open of the day. Went to a new high, went to a new low, went to a new high. It's not crazy or impossible to think we might go to a new low and have an expanding triangle trading range day. So that's what the bears are looking for here. They're betting it's a low probability trade, and it has to be, because let's say you're selling below 53. Your risk is maybe 4.5 points, and your reward, if you're selling going for a new low, is like 15.5 points. So your risk reward profile is really strong, and you can't have a good risk reward profile and high probability. So bears will take that trade as a swing, looking for a sell-off and hoping for an expanding triangle day. The bulls, they had a decent rally, a couple legs up. They're more likely a support in this area. And then the surprise bar, 55, we plunged down. We tested lower prices. It's really interesting where we tested. I should have mentioned that earlier. I did notice it, but didn't say it. 21 is the swing point. It's a weak signal bar. Bottoms usually don't form with weak bars like that. But that you can see that remained the low of the swing point. So that price is high is a test magnet. And then look where 54 tested, or 55 tested right to that signal bar's high. So sell vacuum in a trading range day. So again, this momentum can get beginners into trouble. They see a strong bear bar 53, another strong bar 54, and then this huge bar 55, and they think, I got to get short. We're selling off. But the problem is the context. You're in a trading range, and the close of the bar is in the middle of the range, right where I said there's probably support. We're probably going to bounce here. Why are we going to bounce here? Because bears who sold here got this rally. And if you sold here and then the market's giving you a chance to exit here again, you're probably going to take it. So a bull trend bar 56. So what about buying 56? 53 through 55 was strong enough for a second leg down. So this could simply be a pullback. You can argue, some traders might call it a failed breakout because you get the bull bar 56, but it's really not enough. It's an inside bar, and inside bars are trading range bars. So the market, there's probably more sellers above. You had bulls buying all the way up, maybe bulls buying below the bull bars 52, 51, 50, any of these bars, and they got trapped on this big bar. So what are they going to do on a retest? They're going to look to sell. And then look what happened, 57. We didn't quite get to that one, but bulls buying below bars. Got this huge disappointment bar, scaled in lower. They're getting the heck out of there on 57. That's what leads to a second leg down. Big breakout, disappointed bulls. We pull back, the rally leads to sellers above, and then we start getting a second leg down. 57 could be the start of it. I said this earlier, low ones are good when you're early in the market cycle and you have a strong breakout, like a strong bear breakout, you get a low one, it's good to short. But 53 through 55 is not a strong bear breakout. This gets back into the terminology again. You can call it a bear breakout. It is breaking out below bars to the left, the moving average, and it moved a big distance. It's probably going to get a second leg. But I call it a vacuum test because through experience, that's what I believe Dr. Brooks would call it and other experienced traders. You're in a trading range, you get high in the range, you get a sell vacuum, we go below a swing point, test a weak signal bar, and bounce. This looks more like a sell vacuum test of support than a strong bear breakout. So low 157, but after a strong bull bar, and the context is bad, in the middle of a trading range. I still think we'll go a little lower, maybe test the close of 55 at a minimum. to let out the bears who sold there. But if we do get there, the bears who sold the close 55 got trapped on 56, disappointed, scaled in higher. They're looking to exit at their original entry. So that will create support. 56 was a strong enough bar for a second leg. Combine those two reasons, we'll probably find support here, bounce. 58, another bear bar, probably going lower. The bulls know we'll probably get here. So why would they look to buy here when they can buy lower? And the bears just looking for a little more down before they bail out of their trade. 58 is a bad stop order signal bar. No one's going to buy above 58. And then 59, you can see where we tested and where we stalled. We tested the low of 56, the close of 55. And now we've had two legs down, one pullback, two. I say the market likes to do symmetrical things, like here, big leg one, pullback, big leg two. But this was a more orderly breakout. I was sort of complimenting this breakout compared to this one. This was three legs down, choppy, lots of overlap, nested wedges. This one was a micro channel all the way up to here, had decent bull bars, tight channel, moved a big distance, and probably a leg count reset, whereas this one was a third leg. So this one should have got a second leg that was symmetrical, and it did. But this one I didn't really compliment because I was calling it a sell vacuum test of support. So we're not necessarily going back down here. If anything, we're going to get a second leg, but that could be the second leg. And then you can see 60, outside bar. So 60, we fell below 59. Bears hoping to get that second leg, but instead we reversed up, tried to break out above 59, but failed. It was a 3-bar micro channel. The bulls got the trend line break, maybe a pullback, and then they buy the close of 60. Looking for a move back up to the top of the range. It looks like the bears are failing here. They tried once, pull back, they tried again. They got an outside bar, so 2 legs down, but 60 is not a great signal bar. Probably more buyers on the close of 60 than above. There might be more sellers above, but also buyers below 60. 61 looks like traders bought the close, but we're stalling at the flat moving average. It's a really tight trading range in here. So it might become a limit order market. It already is a limit order market, and we'll find more sellers above bars and buyers below. Probably buyers below 61. It's a weak low 2, low 1, 57, low 2, 61, but consecutive bull bars at support. 62 triggered the low 2, which was bad context, so there were buyers below. But now 62 is a weak buy signal bar. It's a buy reversal bar, closing above its midpoint, but it's a bear body, so probably more sellers above the bar and more sideways. But you can see we're testing support a few times this line. 63. Some traders might call it a low 3. Doesn't matter what you call it. The point is there's probably buyers below. It's a trading range bar at support. Inside bar 64. Again, so inside bars reduces the probability for breakouts. Probably more buyers below than sellers. And if we do sell off below, we'll probably pull back immediately. It's a tight trading range. There's probably sellers above as well. But then we got the bull breakout 65. It's a weak bar. It didn't close above the price it was trying to break out of, which was the high of 64. It did close slightly above the moving average, but it's flat, and it's an overall trading range day. It's not a very significant breakout, but 65 is a weak sell signal bar, so any bad limit order is a good, any bad stop order, the sell below 65, is a good limit order trade, so probably buyers below. 66 pulled back and then rallied. We didn't quite get below, but you did have traders buying the open of 65, which you can see the tail of 66 tested before it reversed up. Now we have 2 legs up, 61, pullback, 66, but might be strong enough here to expect a little more to the upside and a second leg, especially after the bears failed 2 or 3 times at this support. And now we have magnets above to be tested, like the high of yesterday, the close of 52, and the breakout point may be 53 low. Bear bars create resistance. So if we do test here, probably find sellers at that line as well. And then an outside bar, 67. So it looks like it might have been 2 or 3 legs up, high in this range. Everybody sold 66. Surprise bar, 67. But I sound like a broken record when I talk about outside bars today. Outside bars, you don't want to sell low. It depends on the context. Everything has exceptions. But 67 is an outside bar, low in a trading range. After the bears failed at this price 3 times already, do you really want to sell here? Probably not. Probably more buyers below 67, even though it's a big bar. 68, the bears got minimum follow through, but the bar could not close below the low of the breakout bar. We're still within the trading range. Might get a second leg down, breakout and follow through, bad buy signal. So we might trigger the stop order, pull back, and then reverse. But I do think the downside is limited. 69 triggered the buy, micro double bottom with 68, 69, double bottom with 60. And a decent buy signal bar. Even though there's a tail on top, it's a bull reversal bar at support. 70, we had a tick gap from the close of bar 69 to the open of 70, a sign of urgency. Traders bought the close of 69, and now 70 is a weak low 1 signal bar. Low in a tight trading range at support, consecutive bull bars, probably more buyers below 70. 71 going higher, similar to, where was it, over here. I thought there were buyers below 22, but it didn't trigger. Then there's a sense of urgency, similar here, buyers below, didn't trigger. Everybody actually bought the close of 70. There's no lower tail on 71. 3 consecutive bull bars. Was 67, 68 strong enough for a second leg down? It was, but you can get a deep pullback before the second leg. And the second leg could be really limited. It also could not get a second leg because it could be 3 pushes down. And trading leg 3 for a second leg is the lowest probability. The later the leg, the lower the probability of a subsequent second leg. 72 tried to break out above 67, but there's resistance there. It's the top of a tight trading range, an outside bar, a strong bear trend bar, sellers above. 72 is a weak double top after it's a micro channel, 3 consecutive bull bars, maybe 5 bars without a bear bar if you consider this one not a bear bar, maybe a doji. Not very strong selling pressure, probably more buyers below 72, but we could get that second leg, maybe test 68 close. And then instead, outside bar, almost outside up, 73, triggering the weak sell and then reversing, closing on its high, but the upside's probably limited because we're getting high in the trading range. Sorry I had to pause there for a minute so I forget exactly where I left off, but bar 73 is a strong looking bull bar, but possible expanding triangle, maybe 3 legs up, probably. It's also a second leg here, 1 pullback 2, probably more sellers above, but we may go a little higher and test the breakout point. I'll keep that one drawn actually. So we're going a little higher, 74, but it's a weak bar. Is that a very strong breakout bar? Of course not. It's the first bar breaking above here, 57, the top of this lower trading range, and there's still resistance above, probably more sellers above. Outside down, 75. In general, I've been talking about outside bars as bars that you sell above and buy below, but in this case, 75 is a second reversal and a decent sell signal bar, high in a trading range after 3 legs up, so I would not buy below. We could easily fall a little bit lower. 76, interesting what happened. You can see the tail. If a trader was long, maybe they bought the close of 74, disappointed 75. Look at the tail of 76. They had a chance to exit at their break-even price, and that's a give-up bar. So, decent rally, but 3 legs, so you're taking a chance. Disappointing bar, and then give-up bar. 76 consecutive bear bars, crossing the moving average. That's good for the bears, Now you're in the middle of this trading range where bears sell high, take profits, and bulls will buy, maybe looking for a second leg up. So this is a support area. And then a big surprise bar, 77. And you can see where we're testing the high of yesterday once again and the close of 53 or 52. But I said it was a surprise, but also it's a vacuum test. And it's maybe 2 or 3 legs up. Maybe here. 1, 2, 3. Big bar, but similar to 52. Testing the high of yesterday, but 3 legs up, trying to break out of a channel. And what happened the last time we tried to break out above yesterday's high? We got this big sell-off. So as far as buying here, I would not. Deep pullback, 78, but closed here, so breakout and minimum follow through. But if a bear sold above 76, got trapped here, they got out on 78. They tested their entry price, the high of 76. And for breakouts to be strong, the stronger breakouts have little overlap, which it shows that there's trapped traders. You need trapped traders to provide fuel. And now you don't have bears trapped. $77 is also an interesting bar because I call it a surprise, and it really is a surprise. So you do expect a second leg up, but the context was so bad for it. It's 3 legs up, high in a trading range. And then 78 could be that second leg. It's a deep pullback, and then we rallied again. So on a smaller time frame, it's more clearly 2 legs up. So you might have sellers above 78, high in the range. 79, sellers above, bear bar, but a weak stop order signal bar, so there might be more buyers below. And maybe these 2 bars are the first leg of the surprise. Here's a pullback, and then we get a second leg up. Inside bar, 80. A bull bar closing on its high, but bad context. Probably limited upside. And then 81, a bull bar, but failing to break out above the bars to the left, closing within the range. So surprise, maybe a second leg, maybe a third leg, or leg 1, pullback, leg 2. So we had a bull trading range day. We opened closer to the low and closed near the high, almost at the high. For always in today, let me scroll back. Yeah, the problem with always in, bar 1's a strong bar, but the context is bad. Trading range, big down, big up. So if it looks like it's strongly bullish and always in long, it's probably a trap and it's time to look to sell. So all through this day, I'm not really thinking with an always in mindset. Instead, I'm thinking buy low, sell high, and scalp. So we can go through examples all day long. It looks bullish, but always in is backwards. So you look to sell, probably always in short because of context. Here, tight bear channel, lots of bear bars, but low in the range. Bad context, probably always in long. Here, strong rally, but high in the range. So it looks like it's always in long, but probably time to sell. Here, same thing, but this time 3 or 4 legs up, high in the trading range. Looks bullish, but probably always in short. Here, big bear breakout, looks always in short, but again, bad context. It's a sell vacuum test of support, so probably not always in short, rather look to buy. Tight trading range in here, and then, I don't know, another strong rally, strong-ish, but again, bad context, probably look to sell, and then the surprise, but the context was bad once again, and so, is it always in long 77? Probably not. Probably look to sell in this area. I mentioned earlier for stop orders, really limited amount of stop order trades today because that's the nature of trading range days, especially when they're tight. So for stop orders, what do? You're looking for, one of the most important things you can do on a trading range day is count the legs. So I think the first decent stop order trade today was, let's look back a little further. Big bear breakout, you're expecting a second leg. Here's a strong rally. It's a deep pullback. You're still expecting a second leg. And then you start getting consecutive sell climaxes down to here. Finally, you get a bull bar closing on its high, near its high, 23, at the low of the trading range. After nested wedges, probably buy above 23, look for a swing to the top of the range. And then strong enough rally for a second leg, maybe a 50% pullback, and high 2 buy above 37, and stop below, look to scale in lower. So stop order above 37. And then I actually thought 53 was a decent stop order trade as well, because you had 2 big legs up in a trading range, and the second leg was 3 or 4 legs up, and then a very strong reversal bar. And that would basically do it for stop orders today. You can argue here, maybe you buy above 69. It's an okay buy, 3 legs down, but the signal bar isn't great, and you're in the middle of a tight trading range, so not that easy to do. Limit order trades today, if I go through all of them, I'll basically be talking about selling above every bar and buying below every bar. Very tight trading range in here, so sellers above bars, buyers below. On the way down, bulls will start buying below bars, betting it's a wedge, double bottom. You have buyers at this breakout point, the bar 80 yesterday, high, and then limit order bulls came in there. Strong rally, micro channel, first reversal down should fail, buyers below. And then strong enough breakout here, first reversal should fail, sellers above 35. Bull channel, buyers below bars, sellers above bars, all the way up. And then, of course, 53, a better stop order. Probably not ideal to sell there, high in the range. Or not ideal to buy there with limit orders because you're high in the range. And it's a strong bear bar after consecutive buy climaxes. I thought there was a sell somewhere during 57. After this breakout, you're expecting a second leg, but not ideal to sell the close or sell down here, of course, because you're low in the range. So there's limit order sellers above, selling the 53 low, the 52 low, the 51 low. Only the traders at the 51 low or lower got their limit orders filled, got that second leg. Became a limit order market, tight trading range in here again, so buyers below bars, bull bar 56, buyers below. And then every time we went above a bar, there were sellers. And that would basically be the behavior for the rest of the day. And where do we go tomorrow? When you look at the daily chart, take a mental screenshot of the 5-minute chart today. Obviously a fairly tight trading range day. So you look at the daily chart and you see bull breakout and follow through, a bull bar basically closing on its high. It looks like it's strong, but if you're a bull buying a breakout and you want to buy above the breakout, you really didn't go anywhere after your buy. And again, it looks like bull breakout and decent follow through. And I say that, but it's really almost an inside bar and it's a really small bar. But again, you see this bar, it looks like a bull trend bar closing on its high. It looks really decent. But when you crack open the bar, this is what you have. It's really two-sided. So my expectation for tomorrow is probably sellers above today's high. It's a trading range. Now there is maybe an increased chance, maybe a 55% chance we get the bull breakout because of the momentum up and the lack of selling pressure on the higher time frames. But to me, this is obviously a trading range. So every time we go high in the range, we find sellers, and then we go low in the range, we find buyers. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. And with that, I hope everybody has a good rest of their night. Thanks for watching.